How to make money by investing in stocks. So before we get started, make sure to hit that like button, also subscribe to my channel. Stocks are typically the cornerstone of any investment portfolio. That's because they have a higher potential for long-term growth than other asset classes like bonds and commodities. Investments that offer significant upside also come with a certain amount of risk. The economy and the stock market regularly undergo cyclical corrections that can lead to significant losses if you sell at the wrong time. A good proxy to check the overall health of the U.S. stock market is the S&P 500 index. The average unadjusted return of the S&P 500 from 1996 to mid-June 2022 was 9%, according to an August 2022 report by McKinsey & Co. The study also found that during the same period, S&P 500 returns only declined annually 5 times. Buy and hold investing. Buy and hold investing is the simplest and lowest risk strategy for long-term investors. When you buy and hold a stock, you don't necessarily focus on its return day to day or even year to year. With this strategy, you construct a diversified portfolio of high-quality stocks and exchange-traded funds and ride out long-term market trends through thick and thin. Long-haul investors don't care about economic recessions or bear market downturns because they invest for a longer time horizon. Bear markets can be good news for buy-and-hold investors, Chief Investment Officer at First National Bank of Omaha, representing a buying opportunity. A bear market is when there is a prolonged drop in investment prices. Typically, a bear market happens when a broader index falls by at least 20% from its most recent high. Swing trading. Swing trading is a strategy in which investors aim to take advantage of swings in stock prices that take place over one day to several weeks. Swing traders often attempt to profit from the momentum that stocks can gain when they break out of trading ranges to new highs or lows. Swing traders can use stop-loss orders to close out trades automatically if the stock loses its momentum and reverses in the opposite direction. These traders often analyze a stock's price chart to identify patterns and tendencies, so they can become familiar with the stock's trading action and potentially anticipate how it will react under certain circumstances. Swing traders identify key price levels on a stock chart that may serve as effective buy or sell signals when levels have been reached or breached. Day trading. Day trading is an action-packed and extremely active investing strategy that involves buying and selling stocks multiple times within the same trading day in an attempt to profit from relatively small fluctuations in stock price. Day traders capitalize on the intraday volatility that occurs in the stock market. Intraday volatility refers to the ups and downs of equity prices between the open and close on a given trading day. One popular day trading strategy is scalping. This involves making many minimally profitable trades rather than a handful of larger profits. A scalp trader may seek to complete 40 trades that return 0.1% to 0.2% each, rather than 4 trades that return 1% to 2% each. Dennis Dick, equity trader and market structure analyst at Triple D Trading. Day traders employ several strategies to gain an edge. He often tries to identify market inefficiencies in the relative prices of highly correlated stocks. But other day traders look for trades that become temporarily overcrowded in one direction and are likely to correct in the opposite direction. Good day traders have more than one tool in their toolbox. They employ a number of different strategies and quickly adjust those strategies for changes in the overall market environment. He adds that the keys to successful day trading are discipline and willingness to admit you're wrong quickly. Day trading may be the most exciting way to invest, but it is also the most difficult. A June 2020 study of day traders found that only 3% of all investors who persisted for more than 300 days in the Brazilian futures market made money. Dividend stocks. Many profitable high-quality stocks reward loyal investors by paying dividends, which are regular direct cash payments to investors. The average dividend yield of S&P 500 companies is currently 1.6%, but several S&P 500 companies pay significantly higher dividends. Stock funds. One of the best ways to reduce the inherent risk of investing in the stock market is by diversifying your portfolio. By investing money in a large number of stocks, you can reduce the risk associated with each stock and company. One of the quickest and easiest ways to diversify a portfolio is by buying stock mutual funds, exchange-traded funds, or ETFs. These funds often give investors access to dozens, hundreds, or even thousands of stocks in one easy investment. The SPDR S&P 500 ETF Trust (SPY) is the world's largest and most popular ETF, providing investors with exposure to all 500 stocks in the S&P 500 at around $390 per share. There are subtle differences between mutual funds and ETFs, including how they are managed, traded, and taxed. Before buying, investors should also understand the fees that fund managers charge for maintaining a fund. Invest regularly. Time is an important component of your overall portfolio growth. But even decades of compounding returns can only do so much if you don't continue to save. Let's go back to our retirement example above. Only this time, instead of making a $1,000 deposit and forgetting about it, let's say you contributed $1,000 a year. If you started making those annual contributions at age 20, you'd have saved about $325,000 by the time you celebrated your 70th birthday. Even if you waited until 60 to start saving, you'd wind up with about $15,000, a far cry from the measly $1,800 you take out if you only made the initial deposit. Making regular contributions doesn't have to take much effort. You can easily automate the process through your 401 or brokerage account, depositing a set amount each week or pay period. We even have a list of the top brokerage accounts to help you get started. How to buy stocks. These days, buying stocks is as simple as opening a brokerage or regular investment account online. Picking a broker is an important decision that you shouldn't take lightly. You want a firm that won't hold you back with fees, hidden costs, or a lack of investment availability. For more information, check out our guide on where to open a trading account. Once you have an account, your next move is to select the stocks you want to buy. Check out these 4 steps to picking your investments. And remember, you don't have to stick with buying individual shares. Mutual funds and exchange-traded funds, ETFs, can provide easy access to hundreds of different stocks at once, providing broad market exposure. If you enjoyed this video, don't forget to give it a thumbs up and subscribe for more content. Hit the notification bell to stay updated with our latest videos. Share your thoughts in the comments below. Thank you for watching.